Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, June 13th, 2016. In this video, we'll take a look at the U.S. equity markets, take an overview of the broad markets, and then take a look at a few key sectors and try to keep this one relatively brief. All right, we're starting out here with the SPY, the S&P 500 tracking ETF. Nothing new to report since Friday or in the updates today within the trading room. We had what I call primary downtrend line. This is off the highs back in mid-2015. As mentioned, there was a very good likelihood of a bull trap scenario, which so far has been the case. A bull trap is this false breakout above that downtrend line, occurred on very low volume. And as is the case with most false breakouts, the ensuing reaction once that breakout failed has been pretty impulsive. You can see these two candlesticks on above average volume. I have the volume bars muted down very much, but you can see, or you can look at it on your own screen. The last two trading sessions, today and Friday, were on elevated volume further, and you can see, of course, the impulsive nature of the sticks down, relatively large down days, which helps to validate that bull trap scenario. So how much farther does it have to play out? Well, I've made the case, and I'll do that again in this video, that I'm not even really putting up targets right now. And I had some near-term targets on some of the sectors that we're trading, some ETFs, but for the most part, I'm viewing this as a swing trading op for the next what will likely be the next swing tradable leg down. By swing tradable, I'm talking a trade that you can put on for several weeks, if not several months, more likely measured in months. And I base that largely on the fact, as I go through this video, you'll see one common theme, and that is just about every major sector that I'll cover today, as well as the broad diversified indexes, have negative divergence on the high. And for those of you who followed the site for a while, when it comes to the daily time frame and you see these positive divergence that here we had from this point to this point, and I've covered this many times over, more often, much more often than not, when you have confirmed negative divergence on the daily time frame or positive divergence, that leads to multi-month trend changes, what I call tradable trend changes. Tradable meaning for a swing trader, someone who can put those trades on even if you work a full-time job, sit back, stops in place of course, but try to catch the bulk of a trend. And that's what I think is in the works here. So that's the SPY. And again, today, the point to today's video, there's not a lot new to cover, although I will touch on some sectors that I might not have highlighted recently. But so far, down another, almost 0.8% today in the SPY, and that just further validates this failed breakout in the bearish scenario. The divergence, by the way, before I move off the SPY, you can see here we're looking at pending MACD cross. The MACD lines are just right there. In other words, any more downside tomorrow or Wednesday will almost certainly give me that what I call confirmed divergence with that bearish crossover from the MACD. You can already see that the lines have turned down, putting in a second, a lower high, but I like to see that bearish crossover to help confirm it. And it looks like we'll get that on any additional downside in the next few days here. There's the Qs, same story. We barely poked above the highs, and it was such a weak breakout or failed attempt to get above those highs, kind of traded above the primary downtrend line for a few days, and again, impulsive action, elevated volume in the last couple days. And again, this can play out in the coming weeks to months, unless this proves to just be a near-term overbought correction. And again, I don't think that's the case. That's why I'm doing this video. If I didn't see the divergences in place, then I might think otherwise. But moving on, IWM, as I mentioned recently, one of my favorites. I think a lot of meat on the bone on this one. In fact, about a week ago, I even took the time to do a video primarily focusing on the IWM and mentioned the very steep bearish rising wedge breakdown in this ramp. And I mentioned I've seen these ramps before. I've seen these happen in broad market indices. I've seen them happen in individual stocks where you have a breakdown of a textbook bearish rising wedge, divergence confirming the bearish nature of the wedge and the breakdown. Yet the breakdown, just as it starts to get going, the correction, you see a new ramp to additional highs, and that is very often marked product of short selling, a short squeeze, whatever the underlying reasons are. I have my suspicions. I think that's a large part of it. Undoubtedly, it's a large part of it. But that just it just opens a door for a big move down. And again, most importantly in that case, in this case, when the divergence is extended. So you have the breakdown. Sometimes they even burn through the divergences on these new marginal highs after a breakdown of a pretty big bearish pattern. And the same works in reverse for bullish chart patterns. Sometimes you see a bullish falling wedge, breakout, and then a thrust to one more low before the big move up. Works no different here, but in reverse. And that's what's happened so far. And like I said, most importantly, this ramp, this short squeeze, whatever you want to call it, high frequency trading rip, whatever you want to call it, that's what it is. A big rip up that put in a second and even more steep, larger divergent high. And even before it broke down, that's what I mentioned would be the next sell signal, break, and especially a close under that line, that trend line. We had that last Thursday. Friday very much confirmed with a big down day in the small caps, the IWM we're looking at here. And today we're down over another percent, again on impulsive selling, elevated volume. The volume in the last couple of days has been higher. You have to go all the way back to back to late May to see volume like we've seen in the last 2 days. So again, this was a low volume rip right here. That was another thing to put into question. So that's the broad markets. Really, again, nothing new that I hadn't covered. I just wanted to point out that once again, this is now the third consecutive day. Obviously, this breakout is very clear. We have no chance of getting back up above that trend line, at least not anytime soon. It's so steep that even if the markets were to reverse here, that trend line wouldn't come in till, well, forget about it. It'd be so high, the whole bearish case would be destroyed. So the breakout is completely intact and very healthy on the small caps as well as most of the other indices. All right, now let's go through some sectors. I mentioned the other day the financials is one of my favorite. We had, I think at the time, we had just broken down from the bearish rising wedge, these two lines here. Like everything else, just a very muted follow-up to that breakdown, a push up to a marginal new high, which only served to put in another divergent high, as you can see here. So from the breakdown, push up, a marginal new high, which was a divergent high. That also set up this other wedge type pattern here defined by this uptrend line and that uptrend line up there. And we went on since posting that last week as one of the more attractive shorting sectors. We've broken down and pretty much moved. We're within, 10 cents? We closed within 10 cents of the first target today. So we may get a reaction here around that 22.90-ish level. But ultimately, it looks like the financials XLF is headed down to this 22.10 area. And again, like everything else, this positive divergence, as you can see, is well confirmed with that crossover. The MACD clearly the RSI clearly rolling over. Okay, let's move on to the energy sector. This is USO. I've put up a chart, a little cleaner chart on West Texas crude. This is USO, which tracks WTI pretty well. And a little bit busy. Please ignore all the other trend lines, the color-coded ones. Look at the white trend lines here. Essentially, we had this rising wedge pattern, a breakdown, just like on WTI, a breakdown of the rising wedge, these two uptrend lines here, a back test right at the apex. And we broke down very close to the apex, unusually high. Took out on WTI that key $50 level, as I mentioned, but failed. And so we're back above. That was a failed breakout of 50 for those bulls that were watching that. For the bears that were watching what I was watching, more importantly, the bearish rising wedge pattern, all we had is simply a breakdown and backtest and a successful backtest, meaning prices rolled off the trend line after the backtest. So not much else to say there. I think in the coming weeks, crude will continue lower and we'll probably head down maybe to as low as this 1070 area in oil. So, I continue to remain as I have all year long, longer term bearish, but at this point I'm longer term bullish as I've been since early in the year. Intermediate term bearish, looking for a little more downside here. And we'll look at some of the energy sectors. XLE, probably the most popular traded ETF. You can see the breakdown, and a lot like the broad markets, energy sector is a big component of the S&P 500, good size component at least. You see the breakdown, and it kind of a painful, slow, and laborious back test working its way up to finally have that last minute ramp. It seemed like the whole market's had this last minute thrust up, sort of like a blow off top. And like everything else, I'll just draw it out here for you. that last thrust put in a divergent high. If you didn't already have a divergent high before on the breakdown, you certainly had on just about every sector, every important sector that I follow, a divergent high. Again, I'm talking from the previous peak to that most recent peak. So this line here against the MACD and RSI. And this looks like that divergence is now confirmed here on XLE. And that one appears to be headed lower with oil. And there's a couple others we follow. XOP is still an official trade idea, XOP or the 3-time leverage ETF Gush. This one's been covered quite a bit lately. We have this, the purple lines here, this ascending broadening wedge pattern. Call it that, don't call it that. If you don't like how long it is, that's fine. But the more important thing is this uptrend line. It's hard to argue the number of reactions, this uptrend line here. It's very well defined. And today we broke down, traded below it all day and closed below it. That was also below this horizontal support level, 35.25. You go back here, you have quite a few reaction highs. Not the most solid support level, but there were also some reactions above there once we took that level out. So I do have it. I think there's some significance there. Point being, that's a breakdown below 2 support levels and a close below both those support levels, which opens the door for more downside and ultimately move possibly to this 31.69 area. Although my official price target right now remains, as we were in this trade back here, we went ever so slightly underwater by only a couple percentage points, and we're still not stopped out on that trade. In fact, it's profitable once again, and this is the final target at this time. I may extend that. It depends. There's a potential target down here around 28.60. All right, one more ETF. I covered this one in a static post today, so I won't go over too much detail, but these three really are probably the most popular energy sector ETFs other than those that track crude directly. These hold the energy stocks. This is XES, the oil and gas equipment and services ETF. And there's so much here. Just take a look at the static chart if you will. But the yellow lines show a bearish rising wedge, breakdown, backtest, successful backtest, prices rolling over. The next sell signal will come if and when we get a break of this purple uptrend line. Fairly well defined so far. Little work to get to it. Even if we do get to it, there is a little bit of support just above there. I could definitely draw, if you look right here, a lot of reaction highs, some more reaction highs at this point. So we may, right about the time prices come in there, if we hold up, if we go down sharply tomorrow, we may go through that. But if we hold up around 1850 or so, that's horizontal support. I would call it a mild to moderate support level. And then again, this uptrend line I think is the next key level. If and when that breaks, potential targets are around the 1716 area and then 1625. So that's the energy sector. XLV, this is a healthcare ETF. This is an official trade idea. And you can see just a very clean uptrend line. Again, the charts are working well lately. At times, you can say technical analysis doesn't work. Maybe it works one person, their style, not another. But as of late, my style, which is simple trend lines, horizontal support levels, things of that nature, it's working very, very well. Very well-defined uptrend line. Breakdown here, an immediate back test, and then like everything else, remember we had that low volume ramp, whatever you want to say caused it. It's what happened, and part of that ramp, besides the low volume nature, which really brings into suspicion any new highs or any breakouts, we had, as I just drew here from this peak to this peak, we had negative divergence. And that divergence, as you can see on the MACD, any additional downside in the coming days will certainly confirm that. The MACD is already turned down. So you want to split hairs. You could say it's definitely negative divergence. But again, I like to confirm that divergence with a bearish crossover on the MACD. And but you can see this minor uptrend line I just drew. So this one's starting to finally play out pretty nice. And the targets remain as previously posted. Might be extended depending on what happens going forward. On a related note to the healthcare ETF are the Biotechs. A lot of interest in the Biotechs. This is XBI. What we're looking at, this uptrend line right here, this is what we need to watch. You can draw it a couple different ways. You can try to capture that reaction low, although you only have a couple reactions there. Right now I have it here, just excluding that one. Either way, I'll go over the three major biotech ETFs right now, but this is one I'm looking at. And the story is the same. Let's draw it. Let's use this trend line here and just show you. Like everything else, a daily time frame, we have this negative divergence. You can see prices making a higher high from this point here a couple months ago to the MACD, RSI making about equal highs, just a hair higher, but yeah, that's splitting hairs. We'll call those equal peaks, and the MACD making a slightly lower high and already crossing down, confirming that. So your next sell signal would be a break of that, but you want to, when trading the biotechs, keep an eye on all of them, meaning IBB as well. That's the NASDAQ Biotech ETF. And here's the uptrend line that I'm watching here. Connects pretty much these three reactions down on the lows. Very busy chart here, but what I want to show you, I have two different Fibonacci levels up here. The blue line here is measured from the recent lows right here. Actually, I should say from the highs, from where the IBB hit their all-time highs right here back in 2015. That entire move down into the lows is measured by this blue line. So if you go and look over here to the left, here's your 38.2 fib. That's typically the minimum retracement, a healthy retracement and a counter trend move. We didn't even come close to the 38.2 retracement. So for as strong as the Biotechs might have seen, I know they rallied 20-something% off the lows, but that was peanuts compared to the drop. And it's also peanuts compared, if you look at the bigger picture, the Biotechs just had a sick bull market. I mean, a crazy bull run, especially when they launched off this 2011 lows, way ahead of themselves, very overextended. The valuations were insane on a lot of these companies. And, I predicted before it even happened, we'd be looking at a great bear market coming. We got traded the first wave down. We've traded these long and short, but these divergences on the weekly chart, and I've maintained all along, this was probably the first major wave down here in a new bear market in the biotechs, and so far we've seen over the last few months a counter trend rally. I still believe that to be true, but you got to be careful here. You can't go shorting if you're not already. I like to short, and I have been on these pushes back up to this top. This was our resistance level on IBB as well as XBI. I'll mention I put the other fibs up here. We did hit from this major high right here. We had this big reaction high. Measure that down to that move there, and we did come up. There's a 38.2 fib, and we fell just shy of the 50% fib. So that was IBB, and the final one is PBE. Same story. This is the area. This is really, if you box it in here, they're all a little bit different because they have different components, different weightings. A lot of the same components, a lot of overlap, but that's sort of the range that we've been in. And the next major direction, I think, in the biotechs will be determined by a breakout, either upside break of that box I just highlighted here, the shaded box, or a downside break. But it seems the similarities between all three of these ETFs is we have these uptrend lines off the lows, and so I believe, I'd say pretty strong, there's a pretty good chance that once we break these trend lines, that'll give us a quick move down to the bottom of that pattern, and of course then a break of those lows back in early February will seal the deal and probably open up the next wave of selling. So there it is again on XBI. Draw it that way if you want. You want to be safe, you move the trend line down here, but same story. You have this, let's box it in here. You have this trading, and I'll go back all the way here because we had that major reaction low, and that's where we failed. This reaction low, we had a push up, fell back down, and so far that's capped the advance, and we've rolled back over negative divergence, as I mentioned. So that's the biotechs. The most objective entry on those was up here. That's why I don't think I've added that as an official trade idea back just yet, but I do have still a position in that I've had for a long time. XRT. Let's look at the retail stocks. Busy chart, certainly, but what we're seeing here, let's see if I have a clean board on this. Give me 1 second. Let's start out here on the weekly chart. This is an uptrend line. I didn't draw the uptrend line off the 2008 lows. Retail stocks, unlike the rest of the market, which most sectors bottom in March of 09. This one bottomed in 08. But this is where trading seemed to normalize. You have the trend line's a little better defined off that level here in 2009. And that to me, or at least from this point, of course, was the bull market in the retail stocks, and they've been in a bear market now for over a year, all the way back in April. Looked like early April is where they topped. And like everything else, I've made the case, whether some of the indexes I know they fell just shy of that 20% mark. I've maintained all along we're most likely in a bear market that's been, well underway for at least a year now. Again, it depends on which index you look at or what sector, but let me try to measure that out for you just to give an idea. Right around the highs here, down to the bottom. So that was a 26% drop. So certainly a bear market already at this point back here in January. Now, something to watch is this downtrend line. Again, we're looking at a weekly chart. So we had a downtrend line, and there was a bear market. We busted above that downtrend line, which on face value, and was certainly bullish as a technical event, we've come back to back test it recently. And again, a weekly chart. So this is just over a month ago, back in May, late May. We moved back off there, but this isn't very healthy action. When you see such a correction to come back to backtest the trend line, you want to see prices keep moving up. I'm not seeing that. The retail stocks look weak. They're rolling over. They had a backtest, low-level backtest, and they're already rolling over not too far from those lows. So if we look at the posture, the PPO, it works well as a trend indicator when it's above or below this zero line, this dotted line here. You're in a bull market, and I like to use the white line, the last of the two to cross. Either way, they're both under right now, so that shows us we're still in a primary downtrend. This is more than likely. This was just the first counter trend rally, I should say, in a bear market. If you're an Elliottian, I should say, use Elliott wave theory. Maybe that's wave one down, wave two up with a big P3 coming, the third wave. And usually you have on a primary cycle is 5 waves, or I'll let you guys that are Elliotticians figure out the wave count here. For bigger picture, I'll take a look at that stuff. But personally, Elliott wave is too subjective and too prone to revision after the fact revisions for my taste. So, but I do like to take a look at things and see something like if it's fitting into the larger wave count. I just don't get into those minute smaller wave counts. Okay, and just flipping back, I flipped back to that daily chart, but I went out to a 2-day time frame to just go back a little further. And what we have here is a pretty well-defined downtrend going all the way back to, when is that? June 21st, so call it late June 2013. We can even go back here, take that line, move that one away, come back here, captures that reaction high. So there you go. You have several reactions, reaction. We kind of sliced through it. We broke down, and then that's where we found support down on this level, rallied back above it, couldn't hold it, fell back below it, and back tested right on it. Now, I haven't moved this line I moved it today, so it'll now show it's been revised, but I haven't moved it in a long time, and we've rolled off that so far. So that's what I had on my daily chart before, along with some other lines. Go back to the daily time frame. And either way, so the retail stocks, and remember, the retail is a huge part of the U.S. economy. If retail rolls over, the consumer's not spending, this economy is in trouble, and there's nothing else the Fed can do at this point to really save this market. They've been pumping it full of money and zero interest rates for years. Sooner or later, that's just going to, we've already seen the point of diminishing returns quite a while ago. So enough being said, there's retail stocks. They don't look so good, but I can't make an objective case to short them here. The chart's a mess, so I just wanted to point that out. And what I meant on XRT by the chart's a mess. I just don't see a clearly defined entry. I don't see well-defined support levels to target. So I just can't make a case to short, where to short, where to buy, where to cover, I should say. Now I've moved forward to XLP. This is the Consumer Staples ETF. XLP, what are the most important things I see here? Well, the divergent high. We had a divergent high back here in August of 2015. You can see the divergent high, long-standing multi-month divergences, almost a year long, and then boom, very sharp correction, very sharp drop in XLP. Powered back up. Forget about this, a longer-term trend line that comes in. Just ignore this blue trend line for now. Most importantly, we have double divergence. We had from this point, you look at the MACD making a lower high up to this point here. Similar again to the broad market and a lot of other things we're looking at. Very well-defined uptrend line. Broke down. We had actually 2 ramps here. We had a ramp right there to new highs, breakdown, pretty well-defined steep uptrend line, sharp correction after the breakdown. Here's another ramp, a second ramp. So you have these 3 consecutive highs shown by this trend line, each one making lower highs on the MACD and the PPO, the RSI and the MACD. So there's a divergent high. Here's a sector if you wanted to short. I think it's very objective. You might as well wait at this point for a break of this uptrend line. But you could, if it pushes back up and makes another marginal new high, especially if it looks like this MACD is going to roll over, you can take a shot up here. Put a 2-3% stop. These are consumer staple stocks. They're not going to move too much. And my target on these would be this area here, 50, call it 50. The actual support's at 51.53, so you set your stop a little bit above that, or your buy to cover order, say 51.60 or so. And again, longer term, when you go to the weekly charts, it may get ugly. This is XLP from a long-term perspective. This was the primary uptrend line. We broke down and back-tested. That's all this is. I have a few lines in here. Let me move that. So you see the primary bull market uptrend line, very well defined, breakdown back in 2015, and a back test. We've back tested that line for the last, for a while now, almost a year or so, but it's pretty clean to me. And if this was a 30-minute chart, a 60-minute chart, I would short this for a short-term swing trade. However, this is a weekly chart, and that's why I can tolerate a back test for almost a year, because it came on the heels of a 6-year uptrend line break. And this looks like it's ready to roll over. The divergences on the weekly chart confirm it's likely to roll over, and if it does, longer term 47.50-ish, I could easily see a move down here to the 43.50-ish area to try to quantify it for you. That would be a move of about almost a 20% drop, and again, that's consumer staples, so you're not going to make 50% on the consumer staple stocks, but it does speak a lot to the state of the U.S. stock market to see consumer staples set up for potentially a 20% drop. It's clear in the charts, in my opinion. All right, last one we'll look at, just to make the case. And again, I'm trying to make a case for a broad-based sell-off is what I'm doing here, going about just about every sector. I can't cover every single sector, but here's this is our defensive sector. This is a sector where in the past you hide out during a market correction, utility stocks, because they're high dividend payers. They have steady earnings. When you go into recession, you might cut back on your spending, but you're going to keep paying the light bill. So utility stocks are defensive issues. They should do well regardless of the economic condition and or the economic cycle, I should say. But this one looks to me like it's heading lower. You have this steep uptrend line here. You had a breakdown, very impulsive selling, 1 ramp, 2 ramps, just like the what were we just talking on the consumer staples, I believe. Here's a clear negative divergence on both the RSI and the MACD. MACD has yet to roll over, so we haven't confirmed that divergence. That's why I have this line up here a little bit. So, the utilities continue to push any higher. They have to go quite a bit higher to burn through this divergence. Let's just put it like this. They could still move up a little bit, so keep an eye on it. I'm not recommending or suggesting to short the utilities. One reason, there's just not a lot of meat on the bone. These utility stocks, even if this breaks down, if you have enough leverage or buying power in your account, leverage it up. I talk about beta adjusting your position size very often. For example, if you're trading the gold mining stocks, and you take typically a $10,000, $20,000 position size, take 3, 4, especially if you're trading nugget or dust, then you have to chop that by half or by another third. But just GDX alone, if you're normally trading a $10,000 position size, don't trade $10,000 in GDX, because you're gonna be mentally stopped out, if not physically stopped out. In other words, if your stop is 3, 4, 5%, they're going to hit you quick, because that's a daily swing in GDX. And, most people can't take the pain when you have a day when GDX is up 10, 15%. It's crazy. But likewise, flip it around. If you're going to short utility stocks, or you're going to trade TLT, the government bond ETF, you can beta adjust that upwards. You can take do $20,000-$30,000 above your normal $10,000 position size. So I'm just using round numbers, whatever your size is. So there it is. So there's a potential trade opportunity for you. I can't make the case right now because I do see support. Even if that trend line breaks, we have support right here. Um, I'd have to look at this chart a little more to give targets, and I'd also look at the ETF. This is just the utilities index. There's an ETF. What is it? DJU, I believe. Oh, there it is, XLU. So there's XLU, same story. There's the utilities ETF. Obviously, the charts will mirror each other. And there's your potential divergent high. So again, not so much a trade idea, more so just the fact that I don't see many places to hide this time around if we're looking at a multi-month correction here. So let's draw that uptrend line if you're looking for the sell signal in the utilities. Let's say you're long the utilities. Let's say you've been long the utilities for a while as a defensive sector, and your primary goal right now is preservation of capital. It's just remember, there are times at almost any point in time you can make money somewhere in the market, but there are points in time, and I think we're in one of those environments where it may be very difficult to make money anywhere. And this is because we're in an artificial investing environment. The Fed has done things that they've never done before. This is unprecedented. Taking rates down to zero and holding them down to zero for this long. We've seen a zero rate environment before in the past, but we've never seen something like this where we're down so far for so long. So there's been a lot of distortions in the financial markets. A lot of these high yielding stocks and high yielding sectors like utilities have been bid up so much because everybody's chasing yield. And bonds have been held down. Bonds have pretty much nowhere to go but up from here. So that's not going to be pretty when rates start rising for all these, the flight out of all these high yielding, low quality stocks, junk bonds. Oh yeah, I wanted to touch on junk bonds too before we wrap this up. JNK. Junk bonds, even though their asset class is fixed income, they actually trade more in line with equities because they're more sensitive to economic conditions than they are to rate changes. So this is JNK, one of the ETFs. HYG is another one. And you can see this rising wedge type pattern. What I've drawn here, we really have two divergent highs. We have a divergent high at this point. You can see the peak in the RSI, peak in the MACD, and now another divergent high right here where the crosshairs, where the horizontal or the vertical line goes. And looks like we do have a bearish crossover on the MACD, and we've just broken down. If I zoom in, here's the trend line. You can see it capturing a lot of these reaction lows, and we broke below and closed below there today. There's a little bit of horizontal support right there around 35, right about where we closed. But any more downside, there's a sell signal on junk bonds as well. So I think I've covered everything. Although I'll just wrap it with GDX. GDX, I pointed out this in some videos last week and updates. This second divergent high, like I said, there's a common theme here across so many sectors, and these are unrelated sectors. These are the gold mining stocks. I've covered utilities, healthcare stocks. Growth stocks, we're seeing the same story. These divergent highs, again, double divergence, consecutive back-to-back negative divergences, and that's what we had in GDX. I pointed out on Friday this bearish engulfing candlestick that we had and said that, bearish engulfing candlestick, although it's a pretty ominous sign, you want to see follow-up downside. Now, so far today, I said earlier today, either in the trading room or on the front page, I can't recall, that we needed to see, or ideally, I should say, to see a close below Friday's close and especially below Friday's lows. Friday's low, I'm holding if you look on the left, it was 25.76. We closed a little bit above that today, 25.91, but very close. You can see today's candlestick, actually, it didn't engulf the top, but we took out Friday's lows at one point, and we closed. The bodies are just about equal. Actually, this body engulfs Friday's body. So that's a fairly bearish candlestick. Obviously, it would have been better to see a big red down candlestick closing well below Friday's lows, but it would have really taken out or negated the bearish nature of this candlestick had we had a big green candlestick today and a move up that closed up above Friday's highs. So that didn't happen. Bottom line, this one's still to be continued. It was to be continued Friday. I mentioned I want to see a little more confirmation. My expectation is still for a move down. I've been consistent pretty much all the way, even throughout this ramp, that I don't think that the bearish case is over yet. I still think we come down to this 2120-ish level, but we'll just have to see. So that's something to watch for, but there it is. You can see the MACD look like it's starting to already curl back down, roll over. The RSI's already made a lower peak. So that's what I'm looking for in GDX, some follow through to the downside tomorrow, especially to take out today's lows. Today's lows were 25.60. So look for a move down below 25.60, especially a close. You also have this gap support right there. We have the bottom of the gap from the other day, and that's actually probably where we hammered off of today. That's probably where prices bounced. I didn't even catch that till right now. So again, look for a move, and especially close below yesterday's lows, and then we'll probably come quickly down. You have a top of a gap here, and some support here, but that'd be a pretty nice move in itself. That's already 6% drop or so just to get down to the top of that gap there. So there's GDX, and I'll wrap it up here. This video's gone long enough. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.